Good morning, everyone, and welcome to our webinar. I hope you and your families are all safe, and thank you very much for the time that you'll be spending with us today. With me, I've got my colleague Leonard Krüger today. Leonard is one of our portfolio managers in our equity team and also sits on our asset allocation committee here at Prudential. I therefore think he's best positioned to talk to you today about our views on multi-asset and equity funds. Before I hand over to Leonard, I just want to remind you that after the presentation, we'll give you the opportunity to get hold of the slides and also give you confirmation of the CPD of this webinar. Today, we'll run a slightly different format. I'll hand over to Leonard soon and he'll take you through a presentation. Please send us your questions on the live chat throughout the presentation. We've got some of our colleagues here who will help answer these questions. And I'll also pick a couple that I'll pose to Leonard after the formal part of his presentation. So without further ado, I'll hand over to Leonard and he'll take you through our views today.
Thanks very much, Peter. Good morning, ladies and gentlemen. Thank you very much for joining us this morning. I've got a lot to get through in the next 40 to 45 minutes, so let's jump straight in. When we started planning this webinar a few weeks ago, we didn't anticipate some of the more recent events that would transpire in the interim in South Africa. So let's rather start this webinar today by talking about the most recent events and the riots in KwaZulu-Natal and Gauteng, and start that with this presentation. On the first chart, what I show you here is a history over the past 8 years of protest action across South Africa. Whilst the recent protests have been focused around the KwaZulu-Natal and Gauteng region, South Africa has experienced protest action over its entire geography over the past couple of years. What you can see from this chart is that these protest actions have been increasing in its regularity and most recently in its violence in terms of its nature. And this has been a devastating impact on the economy and the livelihoods of many people. Now, whilst the motivation of these protests are still debatable in some instances, what is clear is that the social need and the social pressure on our society continues to grow, with inequality and unemployment being experienced by large swathes of our population. What has been particularly disappointing with these recent actions is the break in the momentum of an economy that has been recovering quite pleasingly from the impact of COVID. Similarly, at the same time, we've been starting to see very promising reform developments in the likes of the SOEs and some of the political corruption cases that have manifested in judgments against the likes of former President Jacob Zuma. Now, it demonstrates how hard it is actually to enact reform. And this is a common trend that we've seen across many emerging markets, whether it be South Africa, Chile, or Turkey over the years. Reform is hard to do, but it does make it worthwhile to continue on this path of renewal. Now, during these events, it was very important for us as an analyst team to make sure that where our portfolios were exposed, that we were able to get as quick and as accurate information as possible to try and ascertain where the risk-return outlook for these investments have changed. So the most prominent or obvious areas where we've had exposure would be in the retail and property sector. What I show on this chart is the exposure to each of the different funds, the Inflation Plus Fund, the Balance Fund, and the Equity Fund, to these sectors, as well as other sectors that are perhaps not as directly impacted, but do ultimately also carry some of the burden of these events. So in the case of retail and property, the most obvious areas affected, you can see that the exposure in the Inflation Plus Fund and Balance Fund is fairly limited, somewhere ranging between 5 and 7%. On the equity side, it is a bit more meaningful, but remember that these portfolios are by design a bit more risk-seeking in its nature. So very importantly for us as an investment team has been to determine the extent of the damage suffered by these companies, Do they have adequate insurance in place? And what is the longer term impact on the ability of this business to rebuild and return to normal operations and ultimately profitability? In the short term, we believe that the impact on the company's earnings affected by these riots are actually fairly limited. And that has manifested itself also in the share price performance of a lot of these businesses during this time. What is a longer term question that we need to think about is this break in confidence and setback that the economy has experienced. Does that actually affect the ability of companies to retain higher levels of ratings from investors in the future, given these uncertainties? When it comes to the exposure in the banks and the government bonds in the fixed income space, these exposures are a bit more meaningful. And here the issue of confidence does play a more important and longer term role. It's important to then think around what does this ultimately mean for South Africa and the outlook for returns. And I'll touch on that a little bit later. What has been very interesting in this time period is that despite this turmoil that we have seen over this period, the South African bond market, bank share prices, and retail share prices have been fairly stable, in a way already reflecting the very low levels of expectations that are priced into a lot of these assets. One of the things that have benefited our portfolios during this period of time has been the offshore exposure and the diversification benefits benefiting from that. What you see on this chart is the offshore exposure of the Inflation Plus Fund as well as the Balance Fund since the onset of COVID in early 2020. What you can then see overlaid with this chart is the Rand-dollar exchange rate inverted. So as the Rand weakened, the dotted line is going down. You can see we brought money back by taking advantage of a cheap Rand to buy South African assets. Our offshore exposure reduced. As the Rand has subsequently recovered and strengthened against the dollar, we have again used this opportunity to increase the offshore exposure. And that has stood us in particular good stead over the past while, as the Rand continues to be the main mechanism of the South African economy adjusting to unexpected shocks or turmoil. So for the month of July, all these funds, including the equity fund, actually had positive returns in absolute terms from all of these portfolios. Moving on to COVID. We continue to be in the midst of a third wave, which continues to increase in various parts of the country. Now, COVID has had an already terrible impact on the lives and livelihoods of a vast proportion of South Africans. What I show you in the left-hand panel is the reported COVID deaths, which now sit already well in excess of 70,000 people that have lost their lives. Overlaid with that, I show research from the South African Medical Research Council that show the level of excess deaths. And you can see the clear correlation between the first, second, and third waves and the excess deaths. So South Africa is underreporting the amount of actual deaths that we have seen over the past year and a half. And more than 200,000 extra deaths have now occurred over this time period to what we would normally expect. That is around a 25% increase in mortality relative to a normal year. So the disease has had a devastating impact on lots of industries, whether that be hospitality, the restaurant industry, or tourism. So the progress from COVID vaccines and the rollout and success thereof continues to be a critical component for the outlook of South Africa and the recovery of our economy and a lot of the companies that are listed on the JSE. The vaccines have shown tremendous efficacy in countries where a large proportion of the population has now been vaccinated, with COVID cases in instances still remaining fairly high, but the number of symptomatic or deaths actually decreasing very meaningfully. And we've seen examples where countries have largely returned to normal and their economies already exceed pre-COVID-19 levels. South Africa lags in this instance, And the success of the rollout, as I have said, is critical for us to recover and for those industries and job creation to again start in earnest. What COVID has done, however, is has accelerated an already worsening trend for the fiscus. So the government's level of indebtedness have been increasing ever since the great financial crisis in 2009. On the right-hand panel, you can see how debt servicing costs, so the interest that the government needs to pay on its outstanding debt, has steadily been increasing as a proportion of its revenue. And with the onset of COVID, the amount of additional borrowing required has accelerated this deteriorating trend. Where we sit today, close to 20%, or 1 in every 5 rands, are going towards the servicing of debt, and that clearly takes away funding for the payment of education, healthcare, and other social benefits. With the recent riots, a lot of the municipalities have also seen a significant deterioration in their credit ratings. And where we sit today, most of these municipalities are deep in the so-called junk territory. Our portfolios have almost no exposure to any of these municipalities. South Africa doesn't operate in a vacuum, however, and there are loads of international, global considerations that we need to keep in mind when we think about your portfolio and how we invest it accordingly. One of the most talked about issues has been the resurgence in inflation. In this instance, I use the United States as an example. So with COVID and the shock that there was in demand last year, the base effect for inflation is very low. So what you see at the moment with a very high inflation rate at the moment in the US, close to 5%, it is a base effect to a large extent. And the debate that is happening internationally now is whether this higher level of inflation is in fact transitory or the start of something more sinister and long-term, and the impact that that might have on global bonds and global asset prices generally. This is important for emerging markets as well as South Africa, because it is in essence determines the amount of return that international investors will need to get on their investments above the risk-free rate in the United States. What the black line shows, however, is that the level of inflation expectations, this is considered by the market as a whole, is remaining fairly well anchored at about that 2% level. This is the level targeted by the Federal Reserve in the United States, and it's certainly their view at the moment that these inflation rates are in fact transitory and nothing to be too concerned about. This makes a little bit of sense for us intuitively, since a lot of the effects of this current very high level of inflation is due to the high commodity prices or high shipping rates that are currently prevailing. We do not expect these rates to remain as high in the long term. And in fact, to be a believer of much higher inflation, you would need to expect these very high levels of commodity prices or shipping prices, as the example goes, to go even higher from here, when we believe, in fact, that they could actually be more moderate in the foreseeable future. Environmental, social, and governance considerations have become a very topical issue, and rightly so for a lot of investors and clients alike. What people often do not understand or miss in these conversations is that it is not just a so-called tax or a overlay to the portfolio, but actually an active potential opportunity of seeking future investments for clients in their portfolios. So with the change in an energy, more efficient world of the future, moving away from fossil fuels to cleaner energy, two of the main sectors that will be impacted is in terms of the transport industry and power generation. What this means is that if you compare the amount of minerals to build or construct an electric car, for example, as opposed to a conventional car that we use today, diesel or petrol, you can see on this chart that the amount of minerals or material needed to build these new technologies are multiples of what we are currently used to. This means that the demand going forward for a lot of these minerals will change dramatically, not just where the demand comes from, but also the quantum of demand. So something like copper, for example, has got an extremely good outlook for its demand in the longer term. Now, this has many implications for miners as well as for South Africa. Mining companies are transitioning their portfolios, moving away from minerals like coal and investing in projects like copper. Similarly, a country like South Africa that is traditionally very richly endowed with minerals, but where some of the demand for these minerals will be changing in the future. It is important to keep these things in mind in the long term when you build portfolios, as even though these events seem to happen very slowly, the long-term implications are profound for these companies and stocks. Let's turn to performance. So this chart looks back to the start of 2020, and it includes the shock of COVID in February and March of last year. What it actually then shows is the very strong recovery in the performance of both the equity balanced and inflation plus fund over the subsequent period. We used that time period to make asset allocation changes in the likes of the currency that I already alluded to. But this has also been the case within equities, within bonds, and within cash-like instruments. And what you can see from this chart is that, in fact, all three of these funds are now well above their levels of the start of 2020. In the case of equities, 30% above where we started the year. So by sticking to our process and not panicking or switching aggressively, we have done well, and the portfolios have beaten inflation and reflect that today. If we look at longer term performance, this chart puts out the 1-year, 5-year, and 10-year figures for these three funds. And we compare it against inflation, as well as its objective for the Inflation Plus Fund, or the benchmark, which is the peers in the case of the balanced or equity fund. Our 1-year performance figures are very pleasing, and we are very proud of the fact that we have managed to outperform by almost 12% in the case of the equity fund over the past year. This has benefited our longer term numbers as well. And you can see in the case of the 5 and 10-year numbers, all the funds have returned in excess of inflation over this time. So investors have done well to stick to these funds and have made returns in excess of inflation in real terms to their portfolios. In the case of Inflation Plus, over 5 years, we remain behind our objective to add 3% above inflation per annum for the time period. This has been largely due to the fact that returns have been very low in South African equities over this time period. The balanced and equity funds have outperformed their benchmarks over this time period, a pleasing outcome and one that we are proud of. If we then look at the sources of the return, using the balanced fund as an example, you can see that the returns have come in the past year predominantly from the South African equity market, reflecting the strong rebound of markets and our relative performance that I shared with you in the previous 2 slides. What you can also see is in the middle part of the chart from 2015 onwards is the very low contribution from South African equities shown in red over this time period. And that has been the main reason why portfolios, not just at Prudential, but generally in the South African market, have struggled to keep a pace with historic returns over this time period. So a lot of investors have asked us the question, markets have returned very strongly, and are there any prospects for this to continue going forward? So we believe the outlook for real returns from here, despite a strong rebound over the past 18 months, continues to be very favorable. In the case of equities, we think it's easily possible to generate inflation-beating returns for a number of years ahead. This will not come in a straight line, as events always happen during the interim. The pricing of assets, however, today is attractive relative to its history. You can see that by looking at where an estimated fair value and the long-term returns from these various asset classes have been. What it also shows is that if you compare South Africa on the left to the world markets on the right, you can see that those markets clearly do not show the same level of excess returns available relative to South Africa. So despite all the noise and all the trauma of events in South Africa, our assets are cheap and reflect good value for investors from here. So the absolute returns should be positive. Let's look at the relative returns. This compares South African equities to that of the rest of the world. Here I use a price to book ratio, or the value or the premium relative to its accounting balance sheet. As you can see in the case of South Africa, we are at a deep discount relative to the world at 1.7 versus 3.2 times. The difference between these two is wide by historic standards. We've got a 40-year history here, and it's only really ever been this wide in the late 90s or early 2000s during the global dot-com bubble. Investors will remember that South African returns meaningfully outperformed the rest of the world in the subsequent 10 years last time that this differential was this large. So if we look at the South African market again in a bit more detail, the top panel shows how the price of the stock market has moved since 2006 relative to the earnings or the profits of the various businesses on the market. What you can see on the right-hand side is the very steep increase in the level of profitability of South African companies over the past year. That has benefited the market, and the market has followed suit. But when you look at the bottom panel, you can actually see that it has not kept pace with the level of increase in profitability. And the price-earnings ratio has actually declined further from where it was a year ago. So today we sit at somewhere around 9 times forward earnings, relative to a history of about 12 times. So profitability in South African companies have recovered and are strong. Yes, we believe some of the companies earning profits on the commodity or resource side are perhaps above normal, but this is more than offset by a lot of South African companies like the banks that are yet to recover their profitability to the full extent in 2019 levels. We believe they will ultimately do this. Similarly, the Rand, as I alluded to earlier, the Rand has recovered and looks much closer to fair value today than what it was in 2020. This has been largely supported by the strong recovery in commodity prices, and the level of exports in South Africa are up almost 50% year to date, leading to a very, very strong trade balance surplus, unlike anything we have seen for multiple years in South Africa, certainly since 1994. So these things can change very quickly, and hence it is not, we typically don't make a prediction of where the Rand will exactly sit, but as you can see from this chart, is that it's much closer to a price parity model that we show on this chart. I have shown you our outlook for individual asset classes. We believe returns on offer are attractive. When we look at the Inflation Plus Fund or the Balance Fund, in the wagon wheel you can see the allocation to the various asset classes. In the case of South African equities and property, we have about a third of the fund in the Inflation Plus to that asset class, whereas we have half of the fund in the Balance Fund towards equities and property. We continue to hold a large proportion of South African bonds, both fixed income bonds as well as inflation linkers. These reflect the very high levels of yield on offer in South African bonds relative to the rest of the world. Again, reflecting the risk already in the price, in our opinion. The offshore components are split between foreign equity, foreign bonds, and cash. And depending on the risk profile of the fund, we have increased or decreased the exposure to these portfolios. Delving into a little bit more detail of the top equity holdings. What you can see on this chart is the top 10 names in each of the respective funds with exposure to South African equities. What you can also see from this chart is that the names are typically the same and the proportion of equities invested in each of these names are fairly similar between the various funds. Where it does, however, differ is to the amount of equities that we invest in each of the portfolios. So lower at 28% for the inflation plus, up to over 80% for the equity fund. The equity fund also holds international equities, which are not included in this number. So let's look at some of the names on this list. Naspers and Process remains the largest position across these three funds in terms of its South African equity exposure. I will discuss Naspers in a few minutes. Our second largest position is in MTN, a share that has done very well for clients over the past 18 months. We acquired MTN in a large amount at the bottom in last year, February, March, and April. And the process, or the actions taken by the management team and the operational performance of the business has been very pleasing. We continue to like the share and think there is upside even from here. You will see that we have a lot of exposure to different banks in this portfolio. So Standard Bank, Absa, FirstRand, and Investec make it into our top holdings. As I said, the banks are well capitalized and are, in our opinion, on their way to recover historic levels of profitability. They will restart paying dividends, and they have not made losses and impaired their books over this past year and a half. We also have defensive qualities in our portfolio with the likes of British American Tobacco and Anglo American, both very strong companies with strong balance sheets and returning money to shareholders when they have excess. We have retained our position in Sasol. Sasol has benefited from a recovery in the oil price over the last year and a half, but they have also taken meaningful actions within the business to address the balance sheet concerns. They have increased their hedging, and we believe the business has moved itself into safe harbor when it comes to the balance sheet, and a rights issue is no longer an issue to be concerned with. On the retail side, we have taken a position in the Foschini Group, where we believe a strong recovery in their UK and Australian businesses, as well as a very favorable transaction when they acquired Jet, is not fully reflected in the price today. So our portfolio is diversified, and that goes not just by sector, but also by the profile of the business. This chart tries to illustrate it in a hopefully useful manner for you. The size of the bubble shows the size of the position in our portfolio, and we have ranked it at the bottom according to the average of a number of valuation metrics, things like price to book, dividend yield, and PE ratio. And what this then does is it shows you a divide of owning companies that are cheap on the value side, as well as companies that are perhaps a bit more expensive, but where we believe the growth justifies a higher valuation. We've then also classified them in terms of their relative cyclicality relative to each other. And again, here you can see that we have some that move very differently to the rest of the market, and then some stocks that move more in tune with the market. What it ultimately shows is that the portfolio is exposed to each of these four quadrants in differing sizes, and adds all to the diversity of the fund and the sources of return and offsetting factors within that. Let's talk about Naspers and Process. It's been a busy time period for Naspers and Process over the past couple of months after the announcement in May of the proposed cross-shareholding structure that they will implement if it is successful. The swap transaction is currently open, with the final decision from Naspers shareholders to be made or elected before the end of next week. In this transaction, each Naspers shareholder have been given the option to change their Naspers shareholding for 2.27 new Process shares. If this transaction is successful, what in effect it will mean is that in future, Naspers will contain 40% of the underlying assets of the group and Process will be 60%. This is, however, a very complex transaction with very many considerations and motivations, whether from the company itself or the various regulators or shareholders. We have engaged the company very extensively, as well as other stakeholders in this process. There are many things to consider, whether it is individual or institutional shareholders, South African shareholders or foreign shareholders, regulators in South Africa, the taxman in South Africa, and overseas. So the ultimate motivation of the company is to try and address the material discount that Naspers and Process continues to trade at relative to its underlying assets. We do not believe that this action ultimately will meaningfully reduce this discount, and we were a co-signatory of institutional managers recently to the company to express this view. We continue to engage with both Naspers and other stakeholders around potential future actions to unlock this material value in the group. At the same time, in recent weeks, there have been significant regulatory interventions in China that ultimately affects Tencent, which is the main underlying asset of both Naspers and Process. Where we have seen this before in terms of regulatory intervention, the current environment is quite murky in terms of no specific actions affecting Tencent have been announced to date. What is, however, clear is that the Chinese Communist Party is quite intent on addressing the social impact and social stability of the country. So issues around data protection, the impact on lives, and equality are keen on their agenda list. It is important to note that Tencent has historically always been an extremely conservatively run business, and that they have multiple sources of business and sources of revenue. This is an area that we continue to monitor very closely, and as things develop, we will take action accordingly when we think it is required. With these actions and the level of uncertainty, the Tencent share price is down about 40% from the highs of the beginning of the year. This has meant a material derating, as the level of profitability in Tencent is as yet largely unaffected in our opinion. So what you're getting today when you invest in Process in Naspers is Tencent at a material discount to where it traded fairly recently. You're however also getting Process at a discount to this Tencent, lower Tencent share price. And then you're getting Naspers on an additional discount of that. So what you're sitting with today is, in effect, a discount upon a discount upon a discount. And if you put that in numbers, the value of Naspers and Process today trades at a 700 billion rand discount relative to just its shares in Tencent. They, however, also own other assets, obviously. And these other assets have recently been valued by the company at around 600 billion. So a very material 1.3 trillion rand of discount is available when you invest in Naspers and Process today. The chart shows this discount expressed as a percentage over time. And what you can see is that the level of discount on Tencent relative to in the Naspers entity now sits at over 40%. With this transaction, it is also important to take the JSE and other indices into account. And we are monitoring this impact on the indices and the relative impact these have on various investors in the near term. So when we put this together and we look at the PE multiple that you can get by buying Naspers or Process today, you can see that we can buy Naspers in this example at around 12.5 times forward PE multiple. This is not materially higher than the stock market as a whole. And yet we continue to believe that the growth prospects of Tencent and the underlying other businesses within the Naspers Process group offer materially better growth than the average company on the stock market. So let me conclude and summarize. The recent protest actions have not had a material impact on our portfolios. We were saddened by these actions, but all the companies that we have exposure to, we believe are adequately covered and will in due course recover it to previous levels of profitability. We are always alert to these kind of events and opportunities if they present themselves in the short term. But it's important to remain focused and think about the long term in things like the energy transition and the impact that this will have on mineral demand, for example. We are very pleased with the recovery in our funds and the relative performance of all our portfolios over the past year. This does not mean, however, that there are no more returns on offer, and we think the outlook for returns, even from here today, continue to be optimistic and favorable. The portfolios have benefited from diversification, both across asset classes, by currency, geography, and the underlying exposure that differs between the various funds. Like in the case of Naspers, we are highly engaged on your behalf in the important events that affect these portfolios to make the correct decisions for the portfolios going forward. Thank you very much for your time, and we will now take some of your questions.
Thank you, Leonard. That was quite insightful. We got quite a number of questions from the audience, so we'll run through a couple of these. I think most of the questions that were sent through with the registration, I think we've covered most of them during the webinar itself. A couple that we haven't covered is questions on the commodity cycle. So we've had Louis Martin from Willis Towers Watson asking, is there further scope for growth in the PGM companies? We've had Vinesh from Sasfin asking, is there still some legs in a commodity upswing? And Anthony Brady, also your view on the commodity cycle. So can you give us some insights there, please?
Okay, all right. Just remind me if I forget some of the answers. So clearly, I mean, on the PGM side, these companies, the likes of Impala, Anglo American, Platinum, Sibanye, they're extremely profitable at the moment. What has been interesting to observe is that the share prices haven't fully priced in these commodity prices perpetuating for a long time. So the multiples on a lot of these companies are actually quite low at this point in the cycle. So it actually makes the call around how much platinum exposure you want in your portfolio quite difficult now, because I think most market participants are effectively assuming that prices won't continue to stick at these levels or go higher. So they're discounting some lower price in the future. What is important when we think about investing in some of those specific companies now is that, you know, for quite a number of years, these companies were under quite a lot of stress. So they haven't really invested very much in their future production. So normally what you would expect in a commodity market, if a price goes very high, is you get a supply response. People bring new supply onto the market. But because of the concentration of platinum and related metals to South Africa specifically, you don't really see this supply response, or not in a meaningful way. So the supply side of the equation is actually quite constrained. So we're spending a lot of time thinking about the demand side, because that's normally where people get things wrong when you think about commodities. And that's why that sort of chart around the longer term transition from petrol, diesel cars to electric cars are actually, you know, quite important for a platinum sector, and for the miners by definition. So I think what we've seen generally with sort of a wider commodity basket is that, prices generally are very favorable and that the miners are very profitable at these points. So outside of the PGM sector, we do expect that prices should probably normalize at some point. So there is reason to be more cautious, even though, these companies on current levels of profits and the dividends that they declare might appear optically cheap. You need to be careful.
Yeah, so some of the gold counters have come down quite a bit already.
Correct. What was the third one there?
Yeah, it was. Is the reflation trade over, and is the commodity price upswing still intact?
Yeah, so it's still intact at this point in time. So prices are still very high, and the levels of profitability certainly is very strong, and that's why you see Anglo American, for example, earlier in this week or maybe last week, sort of return an additional $2 billion to shareholders. And that's a large position in our portfolio. So our clients will receive very handsome dividends from these sort of names.
Okay. David Griesel asked about the performance of the resources and then specifically relative to financials. And then I guess probably the question is also more looking forward, our views on that.
Yeah. So I mean, I don't have the exact numbers with me now, but I suspect resources have done quite a bit better than the financials over sort of say the last 12 to 18 months. Certainly, given the comments that I've just made, we were overweight resources at the start of this period, but we have taken profit in a lot of instances. And certainly, on the financials and industrial side, our portfolios have shifted more towards that at this point in time because the recovery hasn't been as strong. And yet, when we speak to these companies or we read their results at the moment, I think the general answer is that their recovery is quite a bit stronger than what I think people would have expected. Had you sat here a year ago, you would never have expected these companies to be as resilient and do as well as they are. So we think there's still quite a bit of opportunity in that space by being in things like the banks or some of the retailers.
Yeah, and then maybe coming back to the financials of these companies and specifically the banks and the insurers. We had lots of questions in the registration on the riots, which you've covered mostly, and the impact thereof on company financials. I understand you had a meeting earlier in the week with the CEO of Sasria.
Yeah.
So is there some useful insights that you can pass on to the audience?
Sure. Yeah, so I think the issue around the Sasria cover is quite important in considering all of this because, it's all very good and well if all the companies tell you, oh, we're insured against this, but the insurer can't pay you or is bust. So I think the message there has been very reassuring. Sasria is a state-owned company. It's got a good profit history, and it's actually fairly well managed. It's well capitalized. It's got good reinsurance agreements, so they don't carry all the risk themselves. They've passed some of those risks on to insurers that are international in nature. And so the ability of Sasria to cover the claims that they expect to come in seems sufficient. These claims are still coming in at this point in time, so they haven't been able to estimate exactly what the level of claims will be. But in the case where it exceeds its capacity to pay, they've already secured funding from National Treasury as the shareholder of this company to essentially inject funds into the Sasria accounts. So people that are insured, we're very comfortable that they will receive the payout to rebuild their operations. And I think, the companies that we've spoken to, especially the sort of the larger retailers, it's surprising and encouraging how quickly most of their operations can get back up and running. And sort of, I think the fact that the whole situation was contained within 3 to 4 days has made a very meaningful difference. I think if it went on quite a bit longer, the situation would have been more dire.
Yeah, and I'm sure the property companies are also well insured.
Yeah, so property companies are all typically well insured. It was more specifically around loss of stock or loss of trading ability. that was important for us to check, and certainly the type of large corporates that we are invested in, they are well covered and well insured. The smaller, medium-sized retailer, the mom and pop store, I am concerned about them, because you don't know whether those entrepreneurs would necessarily have taken the level of cover. But there is talk that government is looking to aid in some instances there as well.
Yeah, and I've also seen some of the corporates stepping in and assisting the smaller and medium enterprises.
Yeah. So I think we'll need to check this level of assistance or financial help. That's something worthwhile for us to monitor for, say, the property companies, for example, giving rental relief or something, which then obviously impacts their earnings.
You've covered the Naspers Process transaction in quite a bit of detail. There's still lots of questions coming through from Henry Shearn here, I think Henry out of Namibia, and Eileen Campbell on the transaction. Maybe your views on, do you think the transaction will go through? I know we can't speak exactly about our own voting on the share. It's still in process. And also questions here, is the destruction of value recoverable from the recent comments this week?
Okay. I think my base case, or our base case assumption, is that the transaction will succeed. The offer is at a premium to where the share is trading at the moment. So you're sitting in a little bit of a dilemma if you're a Naspers shareholder, because if you don't accept, but your neighbor does, he's going to get all the benefit. So one of the preconditions are that 45% of Naspers shareholders need to tender their shares to Process. So they need to pass that threshold. And I think sort of from the conversations that we've had, some of the calls that we've listened to with international investors, with some of our peers, sort of reading between the lines, I'm pretty sure that the transaction will succeed. In terms of the sort of the regulatory noise out of China this week, so it's important to know that these sort of comments aren't specifically aimed at Tencent at this point in time. So none of the announcements or sort of changes that have been muted directly impact Tencent. It's sort of more looking towards the Chinese internet sector as a whole. So from the point of view of Tencent specifically, we don't think it has affected its earnings ability. Perhaps, a couple of years out, some of the longer term growth opportunities will take a bit longer or not be as great as people might have assumed. So in that regard, to the extent that people were already pricing that in, that might be considered a destruction of value. But we've certainly not seen anything that affects Tencent, like we have, say, the online education sector in China, where essentially the regulations have changed to make those profitable businesses into non-profit businesses, which then clearly destroys the value. It's sort of important to try and also understand sort of the reasoning or the psychology of the Communist Party and why they're doing this. So I think it's actually not that different to a lot of the narratives and sort of investigations going on in Europe and in America around their tech companies. Data security and cybercrime has become a very large thing. The likes of cryptocurrencies. The Chinese are actually just ahead in terms of imposing regulation or control over these things. And, perhaps it comes through in a bit more of a sort of a chaotic manner, but longer term, I would expect very similar type of restrictions to be imposed on the Western technology companies as well. So it's, it feels very chaotic at the moment because we're not sure, and sort of these things take a lot of investors by surprise. But I think the sort of the trends and the themes have been out there and known for a period of time.
Yeah, and I guess it's also important to step back from this particular instance and look at the longer term trend that is happening in China, and where the government wants to take that, and don't throw the baby out with the bathwater, I guess.
I think the one important thing that I perhaps haven't mentioned clearly enough thus far is that the core Tencent business makes the majority of its profits at the moment in social gaming and their social media platforms. And we've already gone through a very extensive regulatory review around internet gaming in China 2-3 years ago. So the last time Tencent had, a similar kind of correction, it was more specifically targeted at their business. And they've come through that very strongly, and they've cooperated with changes in regulation, very, very quickly, and adapted very quickly historically. So I'm a bit more comfortable in that, the core business has already gone through a little bit of this sort of closer inspection from the Chinese regulators. And really it's sort of a bit broader, sort of general internet, this sort of scrutiny that the sector is undergoing.
Yeah, I think one thing that also, to bring it slightly closer to home, when we talk to clients about the equity benchmarks, it's quite important that you look carefully at what equity benchmark you try and follow in South Africa, because there are some of the widely used benchmarks that have got 20, 24, 5% plus exposure to a single stock, which might be fantastic for a number of years, but can have what we call earthquake risk in here. And I think we follow on most of our funds where we have discretion cap swings, where these all shares are capped at 10%.
Yeah, that's right. And so I think that's an important risk management strategy that we use in the portfolios, and sort of try and persuade the clients to essentially potentially leave some money on the table, as you said, because it's done so well historically, but just from a risk management point of view, and sort of the unpredictable nature of investments by its very definition, you don't want to be 25% in a single name. That is just dangerous and irresponsible asset management.
Leonard, we've seen the last 3-4 years a lot of money, based on past performance, but a lot of money move into the fixed income and the money market space. Our yield curve is quite steep, and it looks, the longer end of the curve, bond curve, fairly attractive relative to cash. You sit with many Indian investors sort of asking the question, I'm now getting 3-4% from my money market fund. Should I move a bit higher up the yield curve? Is there benefit for me to do that? And what are the risks, I guess?
Yeah, so I've sat on a couple of panels in recent months, like bemoaning this fact, that this very trend, because I think that sort of that income sort of low risk, very high real return without taking any risk. I mean, that game is finished. Interest rates are sitting, as you say, at 3.5%. So your money market's earning 4%, inflation's running a little bit north of that. So you're going backwards in real terms. What we've certainly done in our multi-asset portfolios, where we have the option to move around the assets, we have substantially reduced the amount of cash that we hold. So we have moved up on the yield curve to try and benefit and enhance the income for those parts of the portfolio. But you've always got to then be very careful, because it does come with more risk. So again, or like always, you diversify, you don't go extremely long. So we've got like cash proxies in the portfolios, instruments that are linked to the level of inflation. So you lock in a real return. And I think the attraction or the benefit of being in a multi-asset portfolio is yet again going to be shown in this environment, where you want as many tools in your kit now to manage and adjust your portfolios to exactly this phenomenon.
And different sources of return.
Correct.
Yeah, I guess a question here from Gerald van Rooy, and maybe this is a tongue-in-cheek question or quite serious, is the REITs the next 10-bagger sector? Property companies, for those of you who don't know what REITs are.
I presume he's got a vested interest, that question. Look, so I think there are certainly a possibility that some of those names can go up very meaningfully. by the very definition, a property company's got quite a bit of leverage. And with leverage comes both upside risk and significant downside risk, as we've seen, over the last 3-4 years, where when you've got a lot of debt on your balance sheet and the fundamentals are deteriorating or going against you, there's a lot of pain. But the exact opposite is also true. So I'm sure if we sit here 2 years from now, there'll be an example where, you would have said, well, this thing's gone up 10 times. But if something goes up 10 times, that means it came with quite a bit of risk. I don't think, there isn't sort of an obvious fundamental underlying property characteristic that would justify that kind of
drive the entire market.
I think where we are today, the prices are discounting a very pessimistic future. So they're trading at substantial discounts to their book because they've got a lot of debt and the fundamentals are difficult. But these guys are also not just standing still. They're working hard. They're doing things in their portfolios. They're selling assets. They're restructuring debt. They're repositioning their portfolios. So it's very possible that some of them could trade out of this very profitably, and that's we're trying to search for those opportunities, and we think we have a few that might to do this, but I don't think 10 bagger is sort of our base case.
Yeah. Thank you very much, Leonard. It certainly helped in understanding and answering all the questions. Thank you to the audience for listening to us and spending the time. I know your time is very valuable to you. Thank you very much for listening. In the next day or two, we'll send you an email with copies of the presentation. So please look out for that. You can download it and use in your client conversations if necessary. Thanks for your time, and we'll hopefully see you soon.
Thanks very much.